When it comes to real estate investing, a lot of people, first initial thought is that I need to save up a lot of capital in order for me to buy the first property. And that could be a rental property, that could be a property that you're going to flip. But in reality, a lot of real estate investors don't actually have that money sitting in the bank account. They simply just have the vision and raise the capital to complete that vision. Robert Kiyosaki started with that. Pace Morby talks about creative financing. Brendan Turner also raised a lot of capital to build his real estate empire, and so should you. And that's why it's important to discuss about how to raise capital. In this video, I'm going to break down 6 common ways to structure a real estate deal. You're going to get a very clear understanding of how each structure works, when to apply them, and at the end of this video, I'm going to give you 2 things. One is my absolute favorite strategy to raise over $30 million in real estate, and the second thing is how do I have access to those type of network. Let's dive right into this. The very first one, wholesaling. This strategy is not for you to actually be holding the property. You're basically going to be finding one property that's a little bit undervalued. There's some conversion that can definitely be done for the property or the lot and can bring it over to another investor. This strategy is commonly discussed in multiple different channels, so I'm not going to go into the detail, but basically you can use only a very small EMD, earnest money deposit, $500 to maybe $1,000, sometimes it could be even $100 only, that you can secure the right to execute the contract. So if you're talking to a delinquent seller or distressed sellers that need to offload the property ASAP, you can literally just secure with a contract with a price point that you know you can assign for a profit, and you can bring that contract over to investors that will pay you anywhere between $5,000 to maybe even over $20 to $25K in assignment fee. So not going to go into detail, but this is the very first step that you can do to get into real estate without any of your capital, because those EMD just put it in your credit card. Basically, you're already in real estate investing game. Number 2 is seller financing. Seller finance is a very interesting way to structure the deal because you're basically turning your seller, someone who's trying to offload the property to you, that seller into a bank. And how it works typically is that the seller is going to be holding back some sort of mortgage. And that can be 20%, 30%, 50%, depending on how much equity they actually have. So all you have to do is to approach the seller, qualify for the mortgage, and have the seller agree that they're going to hold back the remaining balance for this property, and that way they get an initial payout to clear out whatever balance they have or have a bit of money in their pocket. But the main thing here is that you basically have 2 different mortgages. One is your conventional mortgage, and then the other one, the rest of the balance, now is being held back by the second mortgage, which is a seller's mortgage. Now you might also come across with some sellers. Sellers will never actually move in the past 30 years. They paid on the mortgages already a long time ago, and basically they're just looking for a way to retire or offload their portfolio so that they can basically start enjoying their retirement. This type of seller, someone can even hold back 80 to 90% of the mortgage in full, and this is how you can qualify for another private lending, and the remaining balance you can easily go to the bank and try to qualify for 10 to 20%, and that's how you can put a deal together without any of your own capital. Now you might be asking, Ping, why does any seller want to hold back any mortgage? Why not just get a payout? The answer is very simple. These people, they just want a tax deferral. Okay, so basically they're probably still working a job, maybe they still have an income, or in some cases after they sold, they still need to allocate into product like GIC or anything that's secure. So instead of them trying to reallocate the funds, they can just sell it to you with the seller financing. They get paid with the interest, and basically this is a way to keep growing their portfolio without getting hit with a huge large tax bill. It gives them a little bit more time to figure out their tax planning, reduce the income tax and all that stuff, and it also allows them to get you to pay a little bit higher for the seller financing option. So the key insight here for seller financing is that the seller cares more about the cash flow than having a lump sum of the cash itself. Number 3, this is another way for you to buy a property without any of your capital. So this is how you do it. A lot of people in 2022 to 2023, they end up buying it at the peak of the market. And for this type of sellers in today's market, it's going to be very, very challenging for them to sell it without taking a big loss. And this is where the substitute strategy really comes in here, because you can literally come in here, talk to the sellers, and explain to them about the situation that you're unable to actually give them the price that they're looking for. But the way to do is that, why don't I just take over your mortgage, that you have no more mortgage payment that you have to worry about on a monthly basis. And once we have the trust set up, me as a buyer, I'm going to be making that payments towards your mortgage moving forward. And if there's any default that happens, you can literally take back the properties, and basically all the contribution that I made towards your mortgage payment now becomes yours. So basically you're solving for the problem of the seller not being able to sell for the price that they want, and by taking over the mortgage, in exchange, you don't come up with any capital for this property. Keep in mind, in order for this method to work, you really need to find ways to generate enough cash flow to cover that mortgage, because there's a reason why these sellers, they're not trying to actually run it as a rental. Typically, you need to run this unit as an Airbnb co-living space, or in some cases, you can just provide the furniture and use the furnished rental as a midterm rental for the local professionals. There are many different ways that you can control that cash flow, but just be mindful that with this strategy, typically you're not buying at a huge discount. You're paying for the price that the seller wanted to take over their problem. In exchange, you basically get a property completely for free. Number 4 is utilizing private lenders. And honestly, private lenders is no difference from any A or B lenders, institutional lenders basically. So how it works is that private lenders, typically you have a little bit more relationship with them. They could be any friends, family, colleagues that you actually know in your personal life. It can also be a private lending institution where they lend it up to maybe 12% to 14%, but they can cover all the way up to 90% loan to value for the property. And this is the power of utilizing private lending. I actually have a lot of connection with the private lenders, and simply because you can do things pretty strategically. You can still qualify for a conventional mortgage up to, let's say, 75% to 80%, and then you still borrow money from the private lenders. And this is how you can really bridge it up to 100% or sometimes even 120% to cover your rehab costs as well. These type of lenders, typically they have two different concerns, and if you can overcome that, getting their money becomes really easy. First one is that, do you have a clear business model that can actually sustain their interest payment on a monthly basis? Sometimes I negotiate with them to push it to maybe quarterly payout or even like biannually payout. But the main thing here is that they need to know exactly how you're going to make those payments. So operation-wise, as a rental is really, really critical. The financial has to make sense, and they need to know that you're a qualified operator. Number 2 is that they also need to know, for their principal payment, how are you as an operator going to actually do a cash out refi and then pay their money back? This part is really critical because private lending is going to be very dangerous if you don't have an exit strategy. Their interest will wipe up all the margin, and this is why they always look at the deal and making sure that you have enough value add that you're going to improve for the property. So you can use the DSCR loan from any conventional lender to bring the money out and then pay them back. And this is basically how we help our member, the lender, to do 2 deals without any of his own capitals. Number 1 deal is that he found a deal with 160K with an ARV of 240K. This is a very quick turnaround deals where your private lender feels really comfortable. Basically, they don't really care about what lender does, credit score, none of that stuff. They just want to make sure that the deal has enough equity. And there's a couple different other exit strategy for the private lender to recoup their capital afterwards. And what lender did is that he just sold the property 6 months later, paid back the private lenders, and he basically pocketed 38K by utilizing other people's money. And the second deal that he's currently closing, the same thing. He got it for 320K, and the ARV is going to be 320K. And lender is going to be making roughly 48K off this project, still utilizing the private lenders. So the key insights here is very simple for private lenders. The deal just has to make a lot of sense that they're not concerned about you not being able to make the interest payment back to them, and they need to know a clear exit strategy on how you're going to pay their money back. And typically, that's to refi or sell the project. Number 5 is what I call joint venture structure. This is very similar as a private lending, except you're not paying them a guaranteed interest payment. Everything's based on the performance of the project. Basically, you raise a capital for the total amount that you need for down payment plus rehab, maybe a little bit more as a reserve fund. And you come in as an active partner to do all the work. I'm talking about sourcing the deal, vetting the deal, putting the boots on the ground team together, and then arrange the financing for the mortgage. And then you're going to be responsible for the daily operation, for the project management, asset management, property management, all the coordinations, including the bookkeeping side of things. And how you work is that after you stabilize the project, you can do one of the two things. You can sell the project and split the difference in profit, or you can kind of turn it or keep it as a rental, and that way you can split the cash flow on a monthly basis. And then also, when you need to do a refi or when you need to cash out from this project, that's a year or 2 years later, you guys can still split the difference in profits afterwards. Typical split is at the 50-50 on the profits for you to do all the work and for the joint venture partner to come in here to provide all the capital for you. And by the way, if you master the skill of raising capital through joint venture partnership, you're never going to be running out of funds because you can just keep bringing the project in, make sure the project gets stabilized. There's no monthly interest payment. Everything's performance based, and you just keep raising more and more capital into your portfolio. So your only limitation, honestly, is you being the operator and see how many projects that you can handle at the same time. Okay, structure number 6 is what I call real estate syndication. Syndication is a little bit different from joint venture partnership. Joint venture partnership, you can have maybe 2 or 3 partners together, but syndication is usually done for bigger projects. So let's say if you have 20 unit, multifamily building that you want to try to acquire, and you know that 1 or 2 joint venture partners is not going to give you enough capital, this is where you look into syndication. Syndication means that you structure a GP LP structure. You being the general partner, you're going to be handling everything as an active investors. And then LP is a limited partner. They basically come in here to supply the capital. So the term is a little bit different, but the main difference is that you're going to be raising capital from multiple different parties. Could be 5, 10, 15 different type of people to join these partnerships altogether. And as a GP, you're going to be fully responsible for operating the entire project, distribution of the cash flow, managing everything the exact same way as a joint venture partner, but now you can structure the payout more like a waterfall structure. Basically, the first 8% goes to LP. The next 4% you can do a catch up return for yourself as a GP, and the rest of the stuff, anything after 12% onwards, we can do a 50-50 structure between the GP and LP. So the main difference between syndication and joint venture is that syndication just go for a bigger deal with more parties involved. And this is basically the 6 common structures that you can use to close your very first deal without any of your capital. Now you're watching up until this point, let me share with you my favorite strategy. I actually like to mix the strategy a little bit. I like to do a private lending with a joint venture altogether. The good thing about joint venture is that I can raise all the capital without having to pay for the interest payment. So what I like to do is that for simple deals, I can literally raise all the capital through joint venture structure so that I'm not responsible for the monthly or quarterly payout. All I need is to find a deal, finance the entire things using other people's money, and when I fully stabilize a property with the tenants living in there, this is how I can approach your conventional lenders, do a cash out refi, and pay back my investors' initial capital. And the rest of the stuff is just a cash flow distribution on a monthly basis or quarterly basis. This to me is the safest way that doesn't actually cause you a lot of financial or mental stress as you're running through the project. And if you want to know exactly how you can access these type of connection, investors or even lenders, give this video a watch.